Hey everybody, this is Spooky's Revenge from PBAlerts, and I want to walk you through the journey of every trader in a very high level view. So this is one of the topics that I talked about today on my live stream, and I got a couple members wanted a recording of it. So we're going to go ahead and make sure that we get this mapped out, because this is one of the main concepts that we talk about in the Lifetime program where we teach the more advanced education. So let's just walk through what the process and intent for each of these three phases is, and then we'll kind of have a better understanding of where everybody's at. So there's three phases that I like to categorize the trading journey into. Phase one is the simplest, obviously. It's where we collect the best data. Phase two is a little bit more intermediate, but that's where we allow for a little bit more optimization. And then phase three is the most optimal, but it kind of has some restrictions in how we want to apply it so that we don't get diminishing returns or obviously potentially higher risk. So most traders start off with phase one, and this is kind of important to understand because this is where most people should spend most of their time, in my opinion, because this is where you get the best data. So phase one is simply, you've got your buy right here, right? Your buy level. Oops, let me, I guess I should draw these a little professionally because I'm on a recording. So here's the entry, right? For whatever reason, whatever strategy we want to employ, we've got some reason to get into a trade, so we place a buy, right? Everybody understands that, whether it's bullish or bearish. Let's, for the sake of this, assume that you're a long trader, meaning that you want the price to go up, so you're going to be buying shares. And then with that, you want to have defined risk, so you've got a stop loss, right? So you've got one buy, one sell so far, and then that gives you a risk range of this size. And then you should have a disproportionate take profit in most cases, so that you've got some multiple of this risk range, but you're also doing the same thing in that you're exiting the trade. You're taking the risk off the table. So phase one here is just a single buy, single sell strategy where you've got some disproportionate take profit ratio, and then you've got a finite set of outcomes, right? Every trade you take should be a loss or a profit of one size. You should get an immediate result. And then the phase one kind of expands because, if you're not automating these, you're going to get different results because you may or may not be able to push the button when it's time to push the button. So maybe the price is, you bought here, price kind of does one of these, it goes up here, and then maybe it pulls back, maybe it pushes up a little bit, and then it sells off really hard, and you would have let an otherwise profitable trade go into the negative, and then you take a loss because you couldn't hit the button, right? That's something we all run into. It's just the story of every trader, and it doesn't feel good, right? So we can automate that to at least offset that part of it. But there's data we can collect. What specifically got in the way of you pushing the button? Were you distracted? Were you just not content with the profits? Was it not enough? Was there some sort of internet issue or electric issue? Did you just not have the ability to execute the trade? What specifically got in the way, right? We got to collect that data. We got to do this a bunch of times. We got to figure out what's getting in the way, because the only thing that takes traders out of the market is when the price goes down and we have to take a loss, specifically big losses that compound. That's what takes you out. Profits don't take you out of the market, okay? So let's focus on the losses and how we can manage them. So the one thing that will never change across all three of these phases is the fact that we have defined risk and that we can execute, right? That is the number one goal at all times, is just to manage risk efficiently and to become a professional manager of risk, okay? So phase one, number one, is one buy, one sell, okay? It's a very easy process. And that's where, again, we get the most disciplined development. We get the most valuable data. And then phase two, we take the same approach in that we're just placing one buy, right? Again, for whatever reason, and we have one defined risk, okay? And instead of selling everything at this target, we've got the risk range, we've got the multiple as our take profit, so we get that disproportionate and higher probability outcome to benefit us. But instead of selling everything here, then we can start to scale out. We can sell maybe 75 or 80% of our shares instead of everything, and then we can move our stop loss up and secure the rest of it. So we get a slightly smaller profit if we take like one win, one loss here. We're not selling everything at the take profit ratio. Instead, we're selling most of it. So we lock in most of the profit, but we still allow some of that to go back down. So in a scenario like this, where the price goes up, we hit our target, and then the price goes down, we're at least locking in more than we would have over here where we didn't hit the take profit buttons. But you still have the same challenge. Are you able to push the button when it's time to sell that 75%? And that's where you don't want to move to phase two until you're solid on phase one, because you're still going to have the same obstacles. So these are all progressions, okay? Now, in this scenario, you're also allowing, because you're locked in 75%, you're also allowing for the alternate outcome where the price continues to move up. And that's the advantage here, is that instead of just locking everything here and then letting, opportunity cost take over, which again is its own obstacle, you're now allowing for the bulk of that to be uncapped. So your profits are uncapped at this point. You can always get more, but you're not necessarily going to walk away with less, especially if you take this stop loss and move it up here after you lock in that 75%. If the price wants to go, it can go. If not, you just lock in the same thing you got here. Okay, so that's an easy way to make the transition from 1 to 2. Worst case scenario is that you move your stop loss up after you lock the 75%, price pulls back down, you just lock all of it right here anyway. And again, it's the same outcome as phase 1, right? So you're not losing anything, but you are gaining the ability to have this alternate outcome where 25% of your shares go a little bit higher, or maybe a lot higher. Sometimes they go up double digits. So why deprive yourself of that once you're aware of it and you know that you can execute it, okay? And then there's various strategies that we can use that are mechanical, such as the 5 candle rule, where we follow 5 or more candles up, and then as soon as one breaks below that, we lock another 75% of the shares that we have, or some majority. And then when we get a higher low, a higher pivot, which has 2 candles on both sides, which have higher lows than the middle one, then we move that full stop from there up to there, up to there, and that allows us to capture the trend. So the 5 candle rule is good for impulses. The higher validated low strategy is good for capturing the overall trend, higher highs, higher lows. Okay. And then in this case, this is where we kind of recognize that there's another advantage we can provide ourselves here, right? And this is where we need to change our mindset a little bit. So rather than viewing our targets as just places to sell, we can use them as opportunities to take a different action, okay? Because remember, this action here where we sell for a profit and this action here where we sell for a loss are ultimately the same. They have different effects, but they're the same action in that we're taking profit, or we're taking risk off the table. So rather than having a target up here for 75% of the shares, why don't we convert this into a stop loss, right? And then what that allows us to do is, instead of just saying, all right, here's the ceiling, we're going to sell most of our shares and we'll still let some run, we can say, all right, now we can just put a stop loss in here. And if it wants to keep going, we get even more profit on that 75%, because that's the bulk of our money. So we want that to, we want to lock that in. But if it wants to keep going, let's let it go, right? We need to find a way to do that. And this is the best way to do that, in my opinion. Instead of just using a take profit, we can use a stop loss. So I'm actually going to share an example that I did yesterday to show that this is something that we can do. So I've got these 3 screenshots here that I took in real time as I was talking to a member. I had a one-on-one meeting with them. And then right after the meeting, I think it was within a minute or so, it's like 30, we had this little scenario set up. So my entry was here at 240, 2.408, and I just used a market order to get in. I was just trying to demonstrate the concept. 2% stop loss, which is set here, and I didn't set a take profit order, right? I disabled that. And then I drew a line where that 3% would be, because I bought here, and then I drew a line. When the price came up here, I moved my stop loss up. That's all I did. Instead of selling all that position, I just took my stop loss and moved it up instead. So that way, if the price wanted to pull back, I still walk away with the same exact profit, or within a few cents, right? Because you're going to have a little bit of slippage there. But I got the same end result as if I would have used a take profit order. However, I moved my stop loss up instead, and that allowed the price to continue pushing. And all I did was just follow it up and choked it out when it pulled back down. So I turned a 3% take profit on a full position into a almost 10% profit on that same full position. And then if I had more than one share, because I was just demonstrating this, I would lock 75% of the shares right there instead of all the way down here at 248. I would have sold them at 263, which is just another like 6%. So I tripled my profit range, basically. That's the goal. So this is what that allows us to do, which is why I think it's important to shift that mindset into what I call a phase 2B trader, right? And that's someone, a B trader is someone who uses stop losses instead of take profits for taking profit. Everybody should use stop losses for stopping out because that's what they're designed for, but we can also leverage them for taking profits because, again, it's the same exact action here. We're just taking risk off the table. So how we do that is up to us. We have a lot of discretion. And an A trader is someone who just uses limit sell orders and just takes profit because they're just done. They just want to lock it and get the profit off the table. And that's okay. There's no wrong answer here. But if we want to optimize, we need to make sure that if we take route B here, we get the same end result as route A, because route A is going to be safer. It's going to be more consistent. So if we're going to take route B, we need to make sure that we have the same end result as route A. Okay, and this is what allows us to do that. So again, I had my entry, I had my stop loss, I had my take profit level, but not an order. Then I moved my stop loss up, and you can put it just above the level too. I just put it below because that's where I dropped it. And then just follow that up if you want to, and if it keeps moving, and then just kind of choke it out as it falls back. So that's what I call a phase 2B trader. And then the cool part here is we can take that phase 2 knowledge, right? And we can bring that back over to phase 1, right? So if you're phase 1, there's good news here, right? You don't have to set a take profit order if you don't want to. If you want those profits to continue potentially breathing, you can take the stop loss and move it up right to where that take profit would be, all the same. And that's all this trade is. It's a phase 1 trade because I didn't scale out, right? So instead of selling 75%, I just sold everything, but I moved my stop loss up to do it, okay? So that's the main takeaway there between phase 1, phase 2, A and B. Now we're going to talk about phase 3, which is where it gets more institutional, okay? And this is how the institutions trade. So when you have a bigger portfolio, you're going to run into liquidity ceilings because you can't buy as many shares as you want to buy without moving the price because there's just not enough supply. So in that case, we have to find creative ways to get filled and also run our positions. So in this case, let's take just a straight move, okay? Let me make that a straight line. Let's just say we're looking at an impulse, right? And we're going to place our buy and our sell, okay? But instead of placing the full buy here, I'm going to place 25%. Okay, and then what I'm going to do is, let me just change this color here. I'm going to come over here slightly above that once I know that it's going, right? Because if this 25% buy stops out, I just stop out on a quarter of a position, it's an even smaller loss than I would have had to begin with, right? But since I'm placing multiple buys, I got a lot more flexibility about how I do that. And I'll walk through it on the chart so you guys can see kind of how it would look in terms of cost basis. But right now, let's just look at the actual approach. So I placed 25% of my initial, the intended amount into the trade. And then shortly after that, I place 75%. So I fill out the position by putting the rest of the money in. That's going to raise my cost basis. So now I need to take my stop loss, which was originally here, and I need to put it up here above my cost basis. So I'm getting in immediately, putting my stop loss right above my cost basis because I don't want a full position to move against me because now I have an expanded range because I added higher than my initial buy. So I have to be mindful of that. So in this case, I then also, because it's a larger amount of money, I want to lock in that profit at a more reasonable rate. So I just want to get a small percentage move off the bulk of my shares just so I can lock them in and move on. Okay? And when I do that, my cost basis doesn't move. And again, I'll walk through this on a real chart. But it is an easy way for me to just lock a small percentage on a bigger amount of money. Okay? And then I can repeat this process as many times as I'm confident in. As long as the price continues to move up, I can keep buying and selling and moving my stop loss up because my stop loss will always be above my break even. So the number of times that I do this is going to reflect the amount of profit that I make. So here is a profit that I would have locked in. Here is a profit that I would have locked in. If I tried a third time, I just stop out at break even, right? Because my stop loss is right above my cost basis. So there's really no harm in this approach other than, if that initial buy stops out, or if I try it on a small account, because you'll get diminishing returns, right? So you kind of have to do this as a response to liquidity issues because you're not going to have good results because you're not going to get the frequency that you want. Okay, on a small account. So you're going to run out of money before you can run out of opportunities. So it's better to do it the other way around. So at least in terms of efficiency. So that's a phase 3 trader. And again, guess what we're going to do? We're going to take the A versus B approach. So A approach just means that here we take our trade and we use a limit order, right? We just sell as a limit order right here and right here. Okay. But instead of doing all that, why don't we just take the stop loss for that 75%, not the full position, but 75% of the shares. And let's just use a stop loss instead, just above that level. Because what's going to happen here is this can now move higher and higher. So we can make more money on that same 75% move rather than just locking it in just like we did here, right? We can allow for variance to the upside And we move from phase 1 to phase 2 in terms of how we approach this market by using this B approach. So let's look at it on the actual chart, because I feel like that's probably where we're gonna get some better results. I'm not talking about the candles. I just want to look at the actual chart if I don't already have it drawn out. All right, so let's just draw some lines, right? We're just going to keep this very simple. So phase 1 is extremely simple. You can use a tool just for that. It's right there, right? You place your buy, you have a stop loss and a take profit. It is what it is, right? And you can do that with these little take profit brackets right here. Take profit, stop loss. And then if you want to move into phase 2, right? Well, actually, let's just start with phase 1. I'm jumping ahead here. So this is our stop loss, okay? And hopefully seeing the lines move will maybe help. Let's just draw a line to represent our move, right? This is just price over time. So we've got our entry here, okay? And then I'll make that blue, and then I'll put a target level right here so we can see where the target is. So phase 1 would buy here, have a stop loss here just in case it pulls back down, right? But in the event that it goes up, we have a take profit. We just lock those profits, okay? Now, I, as a B trader, prefer to get rid of that because I want this to gallop. I want it to run uninhibited. And then all I have to do is place this, like, let's say this is our initial target, right here. All I got to do is take a second stop loss for 75% of the shares instead of everything, just 75% of the shares. I'm just going to move that out of the way. And then if this goes up higher, 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 and then turns around, I lock 75% of my shares right there. And then I still have that extra room for the remaining 25%. And then I can look for higher lows before I move this full stop loss up to there, and so on and so forth. So I can allow the rest of the process to work in terms of phase 2, but I'm allowing that bigger first sell on most of the shares to be expanded, okay? I'm not allowing it to breathe to the downside, only the upside, because that's how I make disproportionate profits. So rather than locking in 75% at 3% all the time, we can then occasionally get 5%, 7%, 12%, 31% if something just wants to blast. Giving ourselves the opportunity to do that without affecting the outcome negatively in case it doesn't happen is the key, okay? So for phase 3, let me just erase, let me just move this back here. And then I'll just kind of move this down here. We'll just kind of simulate this a little bit. I'll move these over here. And we'll just get back to that same first line, okay? So if I'm in phase 3, I'm placing my 25% buy here, and I'm keeping 75% over here because I don't want to add unless I have to, right? So when I place this buy, that's going to give me a cost basis. Okay, that's my average price per share, and that's going to be right here. When I place this 75% bigger buy, let me make that yellow so we can keep that in line. When I add more money to that account or to this position, that's going to raise my cost basis. It's not going to be halfway between the 2 points because I'm adding 3 times as much money here. It's going to be up here about 3/4 of the way. So in that case, I then take my stop loss for the entire position and I put it right above my cost basis. Okay. And then for this piece, I want to take that 75% and I want to lock it in at some responsible level. Okay. And we already know how we can modify that as well. Because if I use a stop loss instead, a partial stop loss, then this can go up even higher, right? And I still have my full stop down here, so if the price does eventually just crash out, I'm protected, but it's always above my cost basis. So if I repeat this process a couple times, let's say I buy here and I sell here on this bigger position, okay? I've got that, I've got that. When I place this second buy here on this line, my cost basis again moves up. Not halfway, but I take my current average and I take the buy, and it's going to be about 3/4 of the way there. So it's going to be about here. And then my stop loss for everything goes right above that. Okay? So once I lock in that initial profit, I'm net positive for the whole trade. The only time I lose money with doing this is if there's a drastic move and slippage happens, or if I don't put my stop loss in place and it moves down against me, and that's an execution obstacle, or if this first buy here just sells off and goes down to my stop loss. And that's why I use a small buy of 25% of the intended amount just to make sure. Okay? Once I put the 75% in, my cost basis is here. My stop loss immediately goes right above that. So that's a break-even scenario. So the only time I lose money, again, the highest risk window here is that first buy, because that's the only time I really run the risk of taking a loss unless there's an execution issue. And that's why institutions do it this way, because it's a very methodical way of just harvesting money when the volume is there and when the volume is pushing without running the risk of having huge losses. So if I can take a 2% risk on a quarter of a position, which is a quarter of my account, and I'm on maybe a $400,000 account, well, let's run the math on that. So $400,000 divided by 4, right? That's 100K. And then I want to multiply that by 0.25 or divide that by 4. So if I can take a 2% loss on $25,000 minus 2%, I will lose about $500. Okay. Now, if I have my $250,000, or sorry, 200,000, and then I add the remaining 600,000, or whatever the numbers are here, much bigger. No, that would be too much. Sorry, let me start over. 400,000. My brain is shut off. I've been streaming all day. Divided by 4, so 100K per position means that I would have my 25K commitment here, and then I'd add 75K here. And then as soon as I do that, my cost basis is here, which means my stop loss goes here, right above it. So guess what I leave with if I get it wrong? 100,000. I don't really lose anything there other than maybe a little bit of slippage here and there. But I'm not risking a 2% move on a quarter of a position. At this point, I'm full position, but my stop loss immediately goes to break even. So that way, or just above break even to allow for that little bit of slippage. So in that case, the only other outcome here is if the price goes up and I make some money. So what is 100,000, right? Plus 3% is going to be $3,000. So my max risk was $500, right? Because I'm risking 2% of a quarter of the portfolio, right? And then my minimum profit here is going to be about $3,000 if I use a fixed 3% ratio and a limit sell order and I get filled. Okay. The alternative here is price goes down, I break even, and I just try it again. So I'm using some settled cash at that point. So it's an opportunity loss. It's not a monetary loss. So once I lock in that 3K, I place my second buy right here, and that boosts my average up, right, to about 3/4 of the way between the two. My stop loss again immediately goes up here, and then I get another opportunity to add another $3,000. So $6,000 at that point. And I could just do this over and over and over again and just keep racking in these moves without using my full portfolio. So if I'm doing this on up to 4 accounts, I'm going to add the 25K, or sorry, on up to 4 buys, I'm going to add 25K first, then I add 75K. That fleshes out the first quarter of the portfolio. Then I sell that 75K. So I've got 25K in the market, 75K in settled cash, or unsettled cash, sorry. And then I've got a profit on top of that. So 28K, or yeah, 25 plus the profit. Sorry, I should be drawing this out. I'll come up with some better graphics to illustrate this. And then I would add another 75K right here for the second buy, because that would be the equivalent of another 75%. So at this point, I've committed 175K total, okay? And then I sell, and then I've got more unsettled cash, and I've got another opportunity on the next trade to add yet another 75K. And this is kind of why you have to do this on a larger account, because you're really just doing this to work around liquidity, okay? So with all that said, the main idea here is just probable outcomes, right? Again, you have to consider all the scenarios. So if the price goes up, you make a profit. If it goes down, you take a loss. The only time you're really risking a quote unquote substantial loss, which is 2% on a 16th of the portfolio, is when that initial buy first moves down. And that's why we use a small position, okay? Anything beyond that, you're going to be break even, as long as you execute correctly and you don't have liquidity or execution issues, right? So that's phase 3. It's a lot more complicated, and I don't mind telling you guys about this because it's going to take a lot of discipline and a lot of psychology and some mindset shifts to actually implement it. But I want you guys to at least know what's possible and see the outcome that you can achieve with the right structure and the right progression. So right now, most traders are here, and that's where most traders tend to land, and that's okay. There's no wrong answer here. This is where we really hone those skills and sharpen our teeth as traders. And that's where I want everybody to spend the most time and collect the most data. Now, those who survive, right, because 90% of traders who fail don't do this kind of thing because they think it's just shapes and colors and just they try to be right all the time. rather than putting a system in place. Phase 2 is where you're really going to spend most of your time, and most of the difficult emotional confrontations and psychological revelations are going to occur here. Once you figure this out and you can master this, this becomes a cakewalk. But that only really becomes useful when you have a larger account and you can't participate meaningfully without affecting the price. And you don't want to do that because it's super inefficient. So with all that said, I'm going to end the recording here. It's been about 25 minutes. It's kind of a longer one, but I want everybody to understand that trading is more than just buying something and then hoping you're right and then taking action whenever you feel like it because you want to lock in a profit or a big loss or whatever most traders do. Doesn't work. Okay. And it's not about finding the unicorn strategy that's going to make a win rate useful. Win rates are a vanity metric, and I've proven that. You guys have seen me make a net profit with 11% win rate. So don't get too sucked in by the hype. It's all about using a system that prioritizes risk management. So at the end of the day, I can teach you guys all this stuff. I can walk you through it, but it's not going to matter, and you're not going to be able to use it meaningfully until it clicks inside of you, which is where our coaching programs come in. I offer coaching. Mad Maverick, the Swinging Bull, they offer more affordable coaching as well. If you're just looking to get started and just looking for something that works, their coaching programs are great. Otherwise, I offer premium, a coaching program in our premium tier membership, as well as the advanced strategies in Lifetime, which is where we also focus on things like strategies about where we use our profits, how we compound the profits, and where we can actually stash the money so that we don't just stay in liquidity issue territory. Because once this takes off, you're going to have a plan for, not just the profits and where you're going to put them so they can compound passively, but you need a plan for your life. Like, what are you going to do once your needs are met and you're no longer doing the thing that you've been doing your entire life, which is survive, right? Everyone is conditioned to make money, but very few people learn how to live with it. Okay. And that's where we get into the advanced wealth management stuff. So this becomes the easy part. It should be very boring. It should be very straightforward and very simple. People make it more complicated than it needs to be. It hurts more than it has to. And it's very frustrating to hear things like what I just said until you figure it out. And then you can kind of look back and like, wow, I was drowning in shallow water. So for the sake of not getting up on a soapbox here, keep it simple, right? Ask questions. Make sure things make sense. Scrutinize everything. Don't trust anybody. Don't trust me, right? Take what I teach you, scrutinize it, collect data, see if it works for you. If it does, great. If it doesn't, that's okay, right? It's just information. So with all that said, most traders are going to be here and they're going to be there for a while. And this is the best opportunity to spend time here and learn about yourself, because that's really what leads to this. Okay? So if that's the outcome you want, you have to get there, and you have to get there in a responsible way that you can replicate over and over and over again, because things will happen, right? You're going to have big blowups. You're going to have outside circumstances where maybe you have to withdraw a bunch of money and you got to start over, quote unquote. If you can grow 50,000 into 80,000, you can grow $10 into 80,000. It's just a function of time. Okay. So with all that said, I'll stop rambling, but I want everyone here to understand that there are definitive and objective progressions that we can make and we can put in place as traders. It all boils down to understanding. So spend time, learn about yourself, share the data. We're here to help you. I'm here to help you. If you're interested in premium, I'm happy to get you in there. We get a little discount. You get a 50% discount for new subscribers. Just use code NEW50. Otherwise, if you're in premium and if you're in my coaching program or Lifetime, this is our bread and butter. Right? We dig into the neuroscience behind it, behind why you can't execute or what you need to reframe. We dig into the psychology of it to figure out what drives the things that prompt those neuroscience related reactions to things, and a whole bunch of other stuff, which you guys obviously know about. So let me end the recording. We're coming up on the 30-minute mark, so I think that's enough. I will see you guys on my next stream, and I hope you guys are safe. Have fun.